If you are a closed-minded person with no ability to think independently, click off this video right now. This video is only for people who are able to think freely. Now, to my dear index investors, yes, I say dear because many of my closest friends and family are right there with you. I have to be brutally honest. You are all making a dumb choice with your money. Now, I know the last 15 years have been yours. You guys have seen success, watched your investments grow, and you've made a decent chunk of change. And I'm glad for you. But here's the catch. I just hope you haven't gotten too comfortable, too reliant on those indexes, because let me tell you what's coming next. It won't be easy. The next decade is going to be nasty if you don't change your ways. The ratio of the S&P 500 index to M2 money supply peaked right before the Great Depression crash. So if you invested at that time, even after a century, you would have made money, but your share of dollars relative to the total would have shrank. Obviously, that doesn't sound very good. You guys might be thinking, I'm being a cherry picker, and that's a fair argument. So let's say you're thinking about index investing right now. As you can see, right now we're in the top 20% of readings. The average annualized 10-year return when we're in the top 20% of readings is a mere 3.64%. This is obviously pretty horrible considering this barely beats expected inflation, and you suffer all of that volatility for a return that's likely going to be less than the risk-free rate of return, the 10-year treasury, which is sitting at 4.25%. Now, beyond that, I want to say, index funds did serve a decent purpose before, but now that they're large, I believe they're largely corrupt. I want to show you guys an example. Let's take a look at SMCI. SMCI joined the S&P 500 index on March 18th. It joined the NASDAQ 100 index on July 22nd. They added this stock basically at the peak, and a year later, it's down massively. As you can see, the NASDAQ 100 already kicked it out. Now, I find it funny that only after an amazing, massive run to the tune of about a 25 bagger in 2 years, they decide, okay, let's add it to the index fund. It just makes no sense. They're nowhere to be seen before this. Now, what's even more interesting, something like SMCI had fraud problems in 2020, and yet for some reason, the S&P 500 committee still added it in. And guess what? Not too long later, 2024, there's more accounting irregularities. It's almost like some big Wall Street players called the S&P committee and said, hey, let SMCI in so we can dump our shares on passive index investors. Another thing I want to mention is that these index funds have no profit taking mechanism. Let's look at something like Intel. Intel was added to the Dow in 1999, right? It gets kicked out 25 years later and replaced by Nvidia. It was added in 1999. You could have made plenty of money multiple times. The split adjusted price is about 21 or so. But despite that, all these times you could have made a multi-bagger, it only kicks it out. It only kicks it out near the low in November, which is just crazy. You're sitting in this for 25 years effectively in the Dow. You get a puny dividend, tiny capital gains, and then it gets kicked out when you could have had a multi-bagger multiple times, but there's just no profit-taking mechanism. And once again, it added Nvidia near the peak, and I'm sure that Nvidia is a great company and might go higher, but the question is like, where were they just 1, 2, 3 years ago for index investors? Only after a historic run, they're like, hey, let's put this in the index. Like, that's horrible. Now, the next thing I want to mention if you look at the S&P 500 top 10 components, they make up over 34% of the index. So if you guys think S&P 500 is a good investment, you're effectively bullish and decently concentrated in these top 10 stocks. I know some of you guys are thinking, wow, these are amazing blue chips. They're going to be on top for decades to come, but that's simply not the case. I want you guys to look at the top 10 companies 25 years ago versus now. As you guys can see, only Microsoft remains in the top 10. Now, for an index investor, this is no good. And I know you guys might be thinking, well, I'm going to be in all the companies that replace the top 10. And that's true. That's true. But you know what? With these top 10 that are a massive weight right now, you guys are going to be riding them all down in a significant way. And you guys won't be able to take any profit because that's just how the index is. And only years, maybe even decades later, the index is finally going to kick them out. And what's the point? What's the point? You guys are not going to capitalize on any of those beautiful returns they produced. Anyway, I've said my piece on index funds. I want to let you all know that you guys can easily beat index funds with a proven strategy back-tested over a century that utilizes index funds in the process. If you guys are interested, feel free to click the link in the description to learn how.